All right, we're going to go ahead and get started in the interest of time. First of all, good morning and welcome to our webinar today, Guidance in an Uncertain Economy. We're pleased to host this so we can introduce everyone to ITR Economics, our new forecasting partner in developing and producing the RV Roadsigns forecast report. This morning we'll learn more about ITR's forecasting approach, revisit the fall forecast in a little bit more detail, and also spend some time learning how members can apply the overall forecast and all that great information into the individual company efforts. Just a few quick notes on ITR. It's the oldest privately held, continuously operating economic research firm in the US. They work across a wide, diverse range of industries and businesses that includes manufacturers, suppliers, wholesale distributors, and trade associations, which makes them a great fit for our purposes. And since 1985, their overall forecast accuracy is 94.7% at 1 year out across various forecasting that they do across very diverse industries. We've got a lot of ground to cover this morning, so without any further delay, I'm going to turn it over to Lindsay Wernham and Eric Post, who's the senior economist at ITR that heads the development of RV Roadsigns and the RV forecasting. Quick note, we will have time for questions at the end. Just submit them in the Q&A button at the bottom of your Zoom screen. So, and the session is being recorded and will be available on the RVA website following the session. If you need to click out earlier, if you have colleagues that want to see it. So without that, without any further delay, we'll turn it over to Eric and Lindsay. Welcome.
Thank you so much, Bill. And it's great to be here today to talk to you here about your new forecast report. And I'm looking forward to going through it. So in terms of what you can expect here today, here's our quick agenda. Bill teed us up a little bit here talking about ITR. So I'll go through that briefly, as well as the terminology and methodology that you'll want to be familiar with when you're using the report. I'll give a quick macroeconomic overview, and then I'm going to be tying that to your forecasts and what it means for the RV industry specifically. And then conclude with a brief little bit on how best to utilize the content in your report and take any questions that you have. So again, just type in questions in the Q&A box and I will get to those at the end, and I'll circle back to whatever slides are necessary here. So Bill covered some of this already. Our mission is really to help businesses make better decisions vis-a-vis either less risk or more profitability. And so our goal at ITR is to take what we are learning from the macroeconomy and really distill it into what business leaders can use. And so that's one of our distinguishing features as a firm. I think the other thing that I would point out that really separates us is we aim to be 100% transparent about our forecast accuracy. We certainly don't have 100% forecast accuracy. Nobody does. That 94.7% accuracy we're very proud of, but of course it varies, right? Sometimes it's higher than the average, sometimes it's lower than the average. And we want to be committed as we work with this partnership with you to making sure that you understand how our forecast is generated, how accurate it's been, and really understand what you're getting through this program with us. So here's just a look at our 2019 forecast accuracy. These are some of the major headline series that we report our forecast accuracy on, major macroeconomic benchmarks for the US, for Europe, China, Canada, as well as some major core segments of the economy like retail sales and housing. 2019 was a good year for our forecast accuracy. 2020, I think it's going to be more of a struggle for sure. We were calling for a 1-quarter recession in US GDP. That has turned into a 2-quarter recession and sharper decline than we were anticipating, thanks to the pandemic in large part. And we'll make sure that we're always reporting out on our forecast accuracy so that you know what to expect, both for these major segments of the economy that relate to the RV industry, as well as the RV forecast specifically in the Roadsigns report. So terminology and methodology. The first question we always get is, how do you make your forecast? What do you base it on? And some of you who may have attended some of the earlier webinars will note that I talked earlier about the four-legged stool, and that's really the bedrock of our forecasting methodology. So the four legs of the stool are divided into the four parts you see here on the screen. Internal trends, those are things like rates of change and data trends. I'll show you a specific example of that in a moment. Leading economic indicators, those are indicators that tend to have a leading relationship to whatever market or industry that we're looking at. So in the case of RVIA, for example, we have a proprietary retail sales leading indicator that tends to lead the RV industry by 1 to 2 quarters. So we are looking at what that retail sales leading indicator is doing to look at what it might suggest for the RV industry. News and market observations. These are things like COVID-19, like you can see the picture of here. Obviously, that is going to color our expectations for any forecast that we're doing right now. Also, something that would fall into this bucket is prior to the generation of these forecasts, ITR reaches out to the OEMs and we solicit feedback on what's going on the retail side, on the inventory side, what is going well for the manufacturers, what they're struggling with, and we incorporate that information into our forecast. So that forms another leg of our stool here. And then the final thing that we look at is our long-term business cycle theory. And this is one of the defining characteristics of our firm is we are not looking to extrapolate linear trends. We are looking at long business cycle movements and figuring out when those turning points in the business cycle are occurring. And so an example I would point you to is prior to the Great Recession. A lot of our competitors were suggesting basically straight line growth, few percentage point retail sales growth, few percentage point GDP growth in 2008 and 2009. We were looking at our system of leading indicators. We were looking at our long-term business cycle theory, and we were seeing that there was going to be weakness as early as early 2007. We were talking about a pretty significant correction coming in 2008, 2009. As we got closer to that, of course, we refined that outlook as we had more leading indicator evidence, as we had additional news and market observations. But that's really one of the bedrocks of our forecasting program, is being able to look at the cycle, not just the trend as it is right now. So I wanted to show you a little bit more about those internal trends, because you'll see that referred to in the throughout the course of your road signs report. So if you look here, imagine that this raw data here, monthly, let's say it's your company's sales. And if you look at the monthly sales here, it's really hard to tell what's going on, right? It goes as low as 1.3 or so, goes as high as 1.9. It's really hard to tell what's going on here. There's seasonality, there's good months, there's bad months. It's all mixed up. And so what we do is we decompose this into a 3-month moving total, where we are taking the most recent 3 months of sales or RV shipments or whatever it is, and we are adding them together. If it made more sense to average them, like in the case of oil prices, of course you wouldn't average the most 3 months of oil prices or add them, you'd average them. You're looking to see what is going on in the 3-month moving total or average here. And here you can begin to see a little bit more of a pattern. You can see that the 3 MMT, as we call that 3-month moving total, is generally rising. You can also see that there looks like there's some seasonality. August tends to be a bit of a down month. So that would be the sum of June, July, and August. Tends to be a little bit lower than the rest of the data. That's going to tell us about some of the seasonality of this company or this industry. That's certainly the case for RV shipments as well. So we're taking that into our consideration as well. The next thing we do is we're going to calculate what we call our 3/12 rate of change, or quarterly rate of change. All that does is look at the most recent 3 months of data relative to the same 3 months 1 year ago. And that says that that 3-month moving total was up 6.0% from where it was before. You're taking 5.3 over 5.0 and converting that to a percentage. Now we can see by looking at that quarterly rate of change that although the data trend is generally rising, like I said earlier, the rate at which it's rising is diminishing. So in other words, we're in a slowing growth trend. That has some powerful management implications, right? If you know that you're in a slowing growth trend, you're going to behave differently than if you know you're in an accelerating growth trend. We do the same thing with our 12-month moving total, and here you can even see a more smooth rise in the data. We're eliminating any seasonality by looking at the rolling 12 months of data. And we do a similar thing where we look at the 12/12 rate of change. This is basically the most recent full year over the full year immediately prior to that. And you can see there that that rate of change is 11.5%. So a couple of things to note here. We can see that the rate of change is rising and the data trend is rising when we're looking at the 12-month data. When we're looking at only the 3 months of data, you can see, right, if I were to go back here a little bit, right, the rate of change on a quarterly basis is diminishing. What does this mean? Well, to put it in simple terms, right, when your quarters are becoming not quite as good as your years, that means that you're nearing a business cycle turning point, right? And so although the company is probably feeling very good right now, right? Their sales are up 11.5% year over year. We can start to see some of that business cycle weakness begin to creep in. And we can start to talk about how the business cycle is beginning to erode a little bit and we're nearing the cyclical peak for this business. So those are the rates of change and data trends. A really, really powerful tool. We strongly encourage you to do this for your own company because it'll enable you to see those movements in the data much earlier than you would be able to see if you were just looking at those raw numbers. So what we can do then with those rates of change is we move the business cycle into 4 parts. We divide it into 4 parts. And the 4 different phases are based on the relative position of the 12/12 rate of change. And you can see here, there's this little kind of white gummy worm looking line. And you can see phases A and B are where the white gummy worm looking line is moving upward. That means that your 12/12 rate of change is moving upward. The only difference is for phase A, the 12/12 rate of change is still below 0. So in phase A recovery, where you are right now for the RV industry, your 12/12 is rising, it's below 0, but things are starting to get better. And I think that certainly in my conversations with the industry is where people are today, right? They're starting to feel optimistic about the future. They're starting to prepare for phase B accelerating growth. That'll be around the corner here soon. Right, when that 12/12 rate of change moves up over the 0 line. And then eventually, right, someday, we're going to be in phase C slowing growth again in the industry. Right? The 12/12 rate of change will start to move lower. It'll still be above 0, but it'll start to move lower. And then ITR is going to be talking more about conservative suggestions, right? Hoarding more cash, being more conservative in your projections. And then as we move into phase D recession, when your 12/12 rate of change dips below 0, right, that's going to be the danger time, right, for your business. So we're utilizing these rates of change to really help you plan for each segment of the business cycle. That's our goal. I just wanted to show you this graphically because I think this makes a whole lot more impact when you can see things on the graph here. So let's imagine we're back here in 2006. Down at the bottom and on the right axis, you can imagine that we plotted our 12-month moving total for, let's say it's your company. And up at the top in the orange line, you can see the 3/12 rate of change. And in the blue line, you can see your 12/12 rate of change. And those are plotted on the left y-axis. Now here you can see, right, your 12-month moving total is moving up. Your 3/12 rate of change in orange has passed above your 12-12 rate of change, you should be feeling good, right? There should be more rise ahead. And indeed, if I go forward in time, that's exactly what happens with your data trend. More rise ahead. This, by the way, is just a sample industry. So just take that into account. Not you guys, but you can imagine, right, actually plotting this for your company. There's a lot of rise, and you can see in there through 2007, the first warning sign pops up. Your 3-12 rate of change in orange passes below your 12-12 rate of change. That's a signal that there's going to be downside business cycle pressure coming. And lo and behold, of course, that continues to come. And we go into the Great Recession. And you could see, right, if we had been advising this company, we would have noted when the 3-12 rate of change dipped below 0. We would have been noting when the 12-12 rate of change dipped below 0. All of those checking points along the way to signal that the business cycle decline was intensifying as we went through the cycle. Now, imagine you're back here in late 2009. Not very much optimism back in 2009, but we would have been able to see in the rates of change that the 3-12 rate of change in orange upward past the 12-12 rate of change, and that's going to mean upside business cycle pressure. Lo and behold, you can see the data trend actually follows that pattern down there on the bottom of the screen. So this is just a quick visual of why it's so powerful to track those rates of change in data trends. And we'll be doing that in the Roadsigns report, and we, again, strongly encourage you to do that for your own business. All right, so I talked a little bit about one leg of the stool. Another leg of the stool is leading indicators. And what you can see here in green is our ITR leading indicator that we publish monthly. And in blue, let's just imagine this is a 12-12 rate of change for an industry. It could be the RV industry, it could be any industry. What we do here is we look to see, do these business cycle peaks and troughs in the green line, in the leading indicator, tend to reliably precede the business cycle peaks and troughs in the industry data? And of course they do. You can see down here in the Great Recession low quite clearly that the leading indicator reached a low and then spiked before the industry reached a low and then spiked. And then you could see the leading indicator declining before the cyclical decline actually occurred in the industry. And so it might even be easier if I shift this forward by the 12-month lead time and align those cyclical peaks and troughs. And if you see the visual there, you can pretty clearly see how well this leading indicator has foreshadowed actual movements in the industry. In this case, we're looking at about a 12-month lead time. In the case of the RV industry, because you guys tend to move very early in the business cycle, the lead time would not be that long for you. So we had to take that into account in our analysis. But you can pretty clearly see what this green line is foreshadowing for the upcoming 12 months for the industry once I shift it forward. And so between those two things, right, your internal trends, your rates of change, and your data trends, and the leading indicators, we're able to develop a systematic way of looking at different industries, of looking at different core segments of the economy, of looking at different economies, and determining what's the most probable outcome going forward. So Bill, I'll shoot it over to you.
Yeah, just real quick, Eric. First of all, just so everybody on the phone is on the same page, that some of those examples you're giving were for generic industries, not specific for the RV industry. That just, generically, not speaking exclusively about the RV industry.
Yep, we'll get to that later.
Yeah, right. One of the things you talked about in your four-legged stool, and certainly some of the things you track rates of change, what impacts that are, U.S. economic indicators that most people are familiar with: unemployment, GDP, specific to the RV industry, auto and car and light truck sales, things like that. Certainly, in this day and age, in 2020, it's the impact of economic stimulus on the economy as we battle through the pandemic. Can you spend a little bit of time going over those economic indicators you guys look at and how you build that into your model.
Yeah, absolutely. So here are some examples here in the section 3, where I'll be going through some of those core segments of the economy and some that are a little more specific to your industry as well. And then I'll get to how that relates to the RV industry here in a little bit. So one of the things we have been looking at, given how fast the pandemic has unfolded, is more weekly and daily data points than we ever have before. Usually we look at a lot of monthly data, but we've really increased the number of weekly and daily data points that we look at. And so what's plotted here in black is the US Weekly Economic Index that's put out by the New York Federal Reserve Board. And you can see how it absolutely plummeted when those shutdowns began. But the good news is that since about late April, you can start to see that it's been in general ascent. It was in a pretty sharp ascent coming right out of the shutdown, and it started to maybe round out a little bit, but it's generally rising still. You can also see that that black line, the weekly index, is above its 4-week moving average, and it's above its 12-week moving average as well. So all of that is good news for what's to come for the US economy. And it's one of the reasons that we are calling for GDP rise in the second half of 2020, is because we're already seeing signs in the leading indicators that we're already beginning to shift into a recovery phase here for the economy. One leading indicator does not make for a trend, let alone a forecast. So we normally look at a whole host of leading indicators. This is just our dozen key leading indicators that we track in this table form every month. But we actually look, we have about 10,000 indicators in our database. We regularly look at, obviously not all 10,000 of them, but a significant, certainly in the hundreds number. But right now, the US leading indicators are telling a really uniform story. If I had given this talk about a month or two ago, we would have seen some rise, we would have seen some decline, but right now we're 12 for 12 on the rise front. So not only do we have this weekly economic index that's rising, we have all of these other indicators, consumer activity leading indicators, financial leading indicators, things like the stock market, things like housing starts, key metric there for a huge part of the economy. So it's a pretty uniform story right now that's shaping up about business cycle rise to come. Another thing, Bill, you touched on a little bit is just how incredibly massive the stimulus measures have been, both from the Federal Reserve and from the legislature and executive branch. Just incredible in terms of their impact on consumer spending. For the Federal Reserve, Chairman Powell is basically saying, we will do whatever it takes to ensure that there's adequate access to liquidity. And he acted quite aggressively, as did the rest of the Federal Reserve Board, in getting that liquidity in during the real brunt of the crisis. And that's in real contrast to when you think back in 2008, 2009, those things took a while to occur. Congress and the president also moved pretty quickly to get in that first stimulus check. Of course, we would have loved it sooner, but all told, right, it happened a lot sooner than it has at certain other recessionary cycles. And so we think this is going to be a really good sign for money in consumers' pockets, able to purchase things like RVs. So I want to show you a clear demonstration of just how massive this stimulus was. So what you're looking at here is a bar chart of US disposable personal income. It's in trillions of dollars adjusted for inflation. And you can just see there in April, there's when those first stimulus checks went out, it's just a massive, massive spike in that data. And normally we see disposable personal income go the other way in a recession, right? It starts to decline. Now you can almost see that right before those stimulus checks went out. You can see it wobble there in March. but really a fantastic amount of money. And even now at 15.5 trillion in 2012 dollars, we're still above where we were prior to the pandemic. So a huge amount of money out there for consumers to tap into. It's just a question of when they will tap into it and in what industries they'll tap into it. Just a quick aside on where we are with the COVID numbers. These were done just the other day. So you can see here in blue, the US plotted. This is on a logarithmic scale, so it's a little easier to see the trend. And you can see we've sort of more or less flatlined here in our case count in terms of the 3-day rolling average. And cases are rising elsewhere in Europe, starting to pick up particularly aggressively in places like the UK. So that's really what it looks like from a COVID perspective. In terms of vaccine, right, there's positive progress on that point. Our forecasts assume that around early 2021, we're really going to start to have some vaccination available to people. And over the course of the first half of 2021, people becoming vaccinated. So that's just a thing to keep in mind as we roll further on into the forecasting section. In terms of the other sort of non Europe countries, other countries as well, China's cases have ebbed down a little bit. Italy's rising pretty aggressively. South Korea's starting to ebb down a little bit, and we're staying relatively flat here. So we'll have to see what happens. If there's a big risk to our forecasts, I would say it is if we see a widespread wave of secondary closures. Right now, you can see this map here. We have about 7 states that are actively reversing their reopening measures. So California, Texas, 2 big ones among them. Just because we're reversing reopening, right, doesn't mean that all is lost. The reversals so far have been pretty mild, not near what we saw back in April in terms of segments of the economy impacted. And so we're just going to have to see, does that second wave materialize? When does the vaccine come out? And how far do we ratchet back, if at all, come the fall, winter flu season here? But so far, nothing, certainly some states that have paused and reversed reopenings, but nothing really even close to where we were back in the spring. Other question we get asked a lot about the economy right now, especially, of course, given the election cycle, is how much does it matter? And this graph here of GDP, that's the white line there, and we've got it, divided up amongst the various administrations. The real takeaway I want you to have here is it doesn't matter as much as some people are going to say it will, right? The economy is, if you think of it like a ship, it's an aircraft carrier. It's massive. It's very hard to turn. It takes a long time for policies to materialize and for those policies to trickle through to the economy. And so if you were actually to look from Carter to Obama, right, you've got 3 Democratic presidents, you've got 3 Republican presidents, right, Reagan, Bush, and Bush again, or the Bush W. If you look at the growth rates for the Democratic administrations versus the Republican administrations, the difference in growth rates across those averages is in the mud. It's very, 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 very little difference in terms of GDP growth rates. So there's a lot of other factors, right? Who controls the legislature, for one, but also more than that, we think really the leading indicators are where you want to be spending your attention in terms of what's likely to come, not necessarily which party is in office. So these are just some some sort of stakes in the ground as far as what needs to happen or not happen, rather, to see that GDP rise in the second half of 2020. And we're expecting that will continue through at least late 2022, by the way. First one I already alluded to, governors don't shut down their states again. If we see those really broad-based shutdowns, we're going to have to lower our forecasts. That's just for sure. Federal government, they're going to need to be growth positive. So far, we haven't seen anything to suggest otherwise. Obviously, a stimulus package, a second stimulus package would really help, but we'll just have to see if that happens or not. In terms of our leading indicator table there, that is 12 for 12 right now, we're really wanting to see those leading indicators maintain through the start of the flu season there. So we're looking for some more green. I should know more next time I do this webinar, whether that is the case. Right now, retail sales activity has had a really nice bounce back since the shutdowns have ended, and we're really looking for continuing 312 rate of change ascent, continued recovery there as those consumers are able to put all of those stimulus dollars to work. So far, things are looking very good there. And then single family housing starts. That area right now is just exploding. All of the, in a good way, the leading indicators for single family housing are just really off the charts positive right now. We've seen great permitting activity. We just need to see that momentum, maybe not at such a breakneck pace, but positive momentum continue through the rest of the year. So that's kind of where we're at there. So Bill, I'll turn it back over to you.
So, right. So, what I'm hearing you say, Eric, is that in terms of economic indicators, everything's in the green, looking good. Certainly what happens next with COVID and with the government stimulus will play a role in that. I think that, one of the things that you heard in our discussions, with the Market Information Committee and the OEMs and suppliers as you went through this, the first forecasting session that you did is, just the incredible growth in the RV industry that we started hearing about, towards the end of April, and just the incredible dealership traffic that we were getting, the interest in RV ownership, the retail strength in the retail sales market. And, certainly the industry has climbed out of a hole and has almost erased a nearly 2-month shutdown in terms of year-over-year shipments. So, just if you could just go over, what you see with the market, to share some of the insight you gleaned as in those conversations as you're developing it, and just given all that we just went through, where does the RV market go in terms of the rest of this year and into next year?
Great. Well, certainly will do. So let's start with the where it goes. You can see our forecast here. So you've got your chart for total RV shipments. The dark blue line is your 12-month moving total. So you can see since sort of that excess inventory working off has happened throughout 2018, 2019, right? You see the decline there. And then you can see our forecast bars there in teal for the 12-month moving total. So if you were to look at the 12-month moving total at the end of 2020, so that's going to be like all 12 months of 2020, we're looking at 424,380 shipments. And by the end of 2021, 507,181 shipments. This is directly out of your report here. So a pretty nice 2021 as well. And I'll get to the reasons behind that in a moment here. But I would just draw your attention to some other features in your report. That you can see basically the table form of this chart down here at the bottom panel. And that's going to include the lower and upper forecast ranges for the 12-month moving total there. So you can see that 424.4 for 2020, the 507.2 for 2021. And so you can really see how those numbers progress through time, not just one particular point in time. So we're looking for you to be looking there at the cycle so you can plan accordingly. in terms of the rates of change, the dark blue line there is plotting your 12/12 rate of change. Like I said earlier, right now, you're in phase A recovery. You can see that your 12/12 rate of change is moving upward, but it's still below zero. We don't think it's going to be below zero for long. By the end of 2020, we're looking for you to be at 4.5%. So what that means in plain English is 2020 as a whole is up 4.5% from 2019 shipments. So that will be in phase B, accelerating growth. So that color, that green color there, you may have recalled earlier, we had our phase A in blue, our phase B in green, our phase C in that kind of orangish yellow, and phase D in red, right? You can see in your road signs report the phases of the business cycle on a quarter-by-quarter basis for our forecast. So that phase B accelerating growth will last into about the middle of 2021, we think. At the top of the cycle, we think you'll be up about 43.6% year over year. So that'd be July through June of 2021 relative to July of 2019 through June of 2020 is that 43.6%. And then we think the business cycle will turn over and you'll see the growth rate diminish in the second half of that year. So that's your forecast. In terms of how we generated that forecast, just a reminder, right? These are the four things that we're looking at, and they can basically all be decomposed into these various different items. So let's start with your internal trends. In terms of your internal trends, on the left chart here, now we're looking at actual RV shipments data. Thank you for your patience while I built the story getting up to here. Now we're looking at the actual RV shipments data. The dark blue line is your 12/12 rate of change. The dashed blue lines are the lower and upper bounds of your 12/12 rate of change forecast. And your light blue line is your 3/12 rate of change. Your 3/12 rate of change is at 6.8%. Your 12/12 rate of change is at negative 9.4%. And so we have our 3/12 has upward passed our 12/12 rate of change, just like we'd want to see in normal business cycle ascent. And so we really, this is just a positive checkpoint, right? That we're moving in the right direction that we want to be moving in. In terms of another leg of the stool, that news and market observations, to a person, everyone reported very strong order activity, very low in inventories. Someone even described it as being dangerously low, of a concerning point. I think if there's a sort of a downside element, it was supply constraints, people just being concerned that they'd be able to make good on the order activity that's coming to them. And then I thought I'd just throw in one anecdote, right? This is data through July. The August Federal Reserve number is out for travel trailers and camper production, and that was up almost 40% versus the same month a year ago. So we definitely know through August that upward momentum is really continuing. And so, like I said, I think we'll see that 12/12 rate of change high materialize around the middle of next year. All right, so here are some of the actual leading indicators that we utilized in another one of those legs of the stool to forecast our RV shipments here. So blue is your RV shipments. Again, dashed blue lines are your forecast. And then the green line is the money supply. So basically what the Federal Reserve controls there, and it shifted forward by 15 months, which is the typical time that we see it take changes in Federal Reserve policy to really fully trickle through to changes in shipments, right? And so that's why we have actual data extending 15 months into the future. And you can see that this relationship is not perfect, right, going back in time, but generally speaking, the peaks and troughs in the green line tended to precede the peaks and troughs in the blue line by about 15 months. And so that absolute surge in that green line is what I was alluding to earlier about, Federal Reserve basically saying, we'll do whatever it takes. And so that surge, right, plainly said, is going to help shipments over the next 15 months. And so we think that that is a major reason why you're going to see some serious growth, right, as we have low interest rate environment, as consumers and businesses have access to liquidity. That is all going to be a positive for shipments. Another leading indicator that I love is savings as a percentage of disposable income. This one just so happens to have 15-month lead time as well to shipments. These are two of our longest leading indicators to shipments. And there again, you can see that the peaks and troughs are not perfect, but generally speaking, they tend to line up. Right? You've got a trough here that preceded the Great Recession trough. You've got a nice bounce back in the savings rate coinciding with a nice bounce back in the rates of change for shipments. And then you had some weakness that foretold the weakness that you've just come out of. And now we have an absolute surge in savings rates. As consumers have basically taken what the government has given them, and a lot of people have stocked it away in their savings accounts. And while that might not be the ideal intent from a fiscal policy perspective, it's a great sign for 2021 because we are quite sure that those consumers are going to have savings and liquidity and funds to draw into to make those discretionary purchases like RVs. Purchases of RVs. So those are just two of the leading indicators. We looked, like I said, we have 10,000 indicators in our database. We looked at, I would say, probably around 100 or so indicators to generate your forecast. Obviously, I'm not going to keep you on this call for 100 slides worth of activity. But if you wish to see our September 8th slide deck, you could contact RVIA, and there are some additional slides of some of the leading indicators that we considered there. I just kind of tried to summarize them all in a table rather than showing you all of these charts. But some really encouraging things for the RV industry, right? All 12 of those key economic leading indicators in that table that I showed you earlier are rising. Weekly economic index is rising. Weekly retails activity has really bounced back nicely from the shutdowns. And I would characterize those charts I just showed you, the very, very low interest rate environment, Federal Reserve being able to do whatever it takes, consumers having a ton of money in their savings accounts, especially at the higher income echelons, right? They received those checks, right? A lot of people in upper middle class received those checks. They may not have needed them, right? They may not have been out of work as much as the people on the lower end of the income spectrum. And by the way, those people just so happen to be RV purchasers. So that, if anything, I would say is an upside risk to our shipments forecast. Certainly the personal income data is favorable, and the housing data is also very favorable, as I said earlier. That upside risk from the interest rates, money supply, and savings rates, we tried to balance that with some of the downside risks that we have seen coming. I would say, like I said, the absolute largest downside risk is that we see a secondary set of broad-based shutdowns. We're not sure what's going to happen with the second stimulus check, if that comes out or not. We have seen a little bit of weakening in some of the weekly and daily data in September in those supply issues, right, that I talked about earlier. The last one I didn't really touch upon, which is the auto industry. And if you look at new vehicle sales, that industry is just really, really struggling. We think that it's undergoing basically it's basically fallout from, if you think back to 2014, 2015, you'd get those ads that would say, 0% down, 84-month loan, come buy a new car or truck. right? And people did that. And now those people are underwater on their car loans. And so it's just becoming harder and harder. And now the pandemic on top of it to get traction in the auto industry. And so since, as Bill mentioned, that does tend to have a pretty decent relationship to your industry, I would characterize that as a downside risk. But anyway, what I was trying to say is we tried as best we can. We want to be objective forecasters. And so we are trying to balance those upside and downside risks and make sure that we are taking those into account when we are generating what we think is the most probable trajectory. And so we'll be updating, as more information comes out about either to the up or to the down, we'll be making sure that we communicate that to you in subsequent reports and in subsequent webinars.
All right, Eric, so from our point of view, from an industry data, the 25th of every month is when we do release our wholesale shipments. That is, eagerly awaited by the industry, as are the forecasts that we do quarterly. And, that's a really good finger in the wind, indicator of, where the industry's heading. What's the industry going to do for this year and the year ahead is always one of the, big questions we get. I think that what would be really of interest to the folks on the, on the webinar today is, so how do you take this, this larger forecast that looks at an entire industry? How do you sort of adjust that to take that information that's in there and apply it to your business, at your business level, not just a macro industry forecast?
Yep, and like I said, that's the number one most important thing for us is we don't want to just be producing economic content in a vacuum. We want to be making sure that it's utilized, can be utilized by you all. And the number one thing I would say is to track your rates of change and compare that to the rates of change that you're seeing in the Roadsigns report. So I went through that 3-month and 12-month moving totals, went through the 3/12 rate of change and 12/12 rate of change. The companies that we work with do that every month. They will look at their rates of change. They are also looking at their business cycle phases, right? If they see that their 12/12 rate of change is already positive, for example, and their 3/12 rate of change is already positive, right? They're already in phase B, accelerating growth, right? And they might be a little bit more aggressive even. They're knowing that they are maybe even outperforming the industry a little bit. The industry companies that we worked with tend to think in terms of those business cycle phases, and we're always trying to get them to think one business cycle phase ahead, right? Because it takes time to implement all of these things. And so we have our what we call management objectives, which are tailored to each phase of the business cycle and are aimed at getting you to be proactive in your business planning instead of reactive. And so planning based upon what's going on in the leading indicators, not what's based on what happened last year or whatever. We want you to be thinking ahead. We'd really encourage you to submit your data, certainly to us, so that we have the best information. In terms of what's going on in the industry, and just make sure that you take advantage of these webinars and ask any questions that you have. So I would say that those are the best recommendations I have. In terms of management objectives, I'll just give you some examples here. Right now that you're in phase A recovery, right? Think about adding sales staff, making sure you have the right top people. Those are some of those phase A management objectives where you're starting to get more aggressive, knowing that you're going to be, we think, slightly over 500,000 units next year for the industry as a whole. Some of you may also find these phase B management objectives of interest, since we're kind of straddling phase A and phase B. We'll be in phase B very soon for the RV industry. So these are just really to prime your pump and get you thinking about what you might do. So that's it from me. I'm happy to stay on to answer any questions, and I will look at the Q&A box here now. And one of the questions is, how much of an impact are supply chain and labor shortages restricting our shipment numbers? How long are these shortages anticipated to carry forward in 2021? And what will the impact on the order backlog? What will the impact be on the order backlog trend? That's a great question. In terms of how much they're restricting, I don't have a firm answer for you in terms of, it's restricting at 10% or 20%. I think the answer for that is going to be different for every company. But in terms of when we expect them to be over, I would generally expect that around early next year, the bulk of your catch up will be over, and that's sort of what we built into the forecast. Is that somewheres around or early next year. That's really predicated on a couple of things. One is that we see very little seasonal shutdown in the industry later in the year. Typically, production tails off a fair amount, just normal seasonality. We're assuming this year that the manufacturers, because of the backlog, are really significantly continuing to produce full out, even in the winter. That turns out not to be the case. I would expect we'll have to lower the forecast for that. But that's really where I see that headed. Let's see. In terms of the order backlog trend, I'll just address that really quick. I would expect that as the, we're not forecasting the order backlog directly, but by the second half of next year, I would see that order backlog is no longer the case. Just based on our forecast, that would be my expectation. So I hope that helps. Let's see. Will this slide deck be shared with members? Bill, I believe the answer is yes.
Yes.
Yep, okay. Have you looked at the new buyers in the RV market? What does that look like? I did have a chance to look at some of the demographic breakdown. That certainly does seem to be a strong trend. I would say in terms of how we built that into the forecast, if that's sort of where the question is going, I would say we assumed that as the vaccine comes out and life gets back to normal, right, we're going to see that rush of new buyers is going to tail off. Maybe not dissipate entirely, but tail off as people are able to maybe fly more, life gets back a little more to quote unquote normal. But certainly we see that as a great sign for the industry going forward, and to the extent that you all are able to capture and really get those new buyers turned on to the industry and stay turned on to the industry, vis-a-vis a positive experience. And I think that really goes to making sure that you're prepped to handle the rising trend, quality, making sure quality stays there, making sure that they have a good experience. And I think that's going to pay long-term dividends. I can't remember the exact breakdown in terms of what the percentage was in the retail data. I will have to, let's see, that person left a name, so I will get back to you, Chris, about that.
Yeah, and one other thing I'll just add, Eric, and to everybody on the webinar, is that we are in the final stages of an all-new consumer demographic profile that Ipsos is doing, and we'll be able to break out first-time buyers and what appeals to them about the industry and why they joined and things like that, that really help us focus a lot of our messaging with Go RVing and drive other association programs across RVIA and RVTI as well. So certainly echoing Eric's point in that, the pandemic has introduced a lot of buyers to the RV market, folks that maybe didn't even have an RV on their radar, are out buying. And, that certainly presents great long-term growth for the industry it's a wonderful opportunity, if we can capitalize on those buyers, and keep them in the market.
Yeah, I certainly, I won't say I've dug enough deep into that data to have a great thinking as far as where the rates of change of that are heading. That I think I'm going to pencil that in as kind of a to-do for the next report, to see if I can't work that in there, at least into the presentation explicitly, because I do think that's a huge opportunity there.
Right.
Let's see, next comment. So I'm going to mark, let's see, I guess I'll answer. I will make sure I get back to you though on that question. Let's see, can you comment on the growth rates for motorhomes against towables? It would appear motorhomes are growing at a higher growth rate in 2021. Sure, I can comment on that in general. Ooh, let's see if my computer allows me here. So generally speaking, motorhomes tend to lag the towables. And we see that across a host of our industries, in the sense that typically, right, during a recession, people will be a little more price sensitive, whereas, as the economy is improving in 2021, people will be a little less price sensitive. And so we think that motorhomes are going to be a little bit better. So in terms of motorhomes, let's go down to Class A here. Right, you can see on the data trend chart, it starts out pretty flat in the 12-month moving total and really hits the gas more later in the year. And you're seeing that ascent occur, especially in the latter part of 2021. And that's really the reasoning behind that, is just that typically we see that delayed effect. In terms of the actual growth rates, that's certainly something we could publish, I guess, in a table or something off to the side. Maybe, Bill, we can take that as a thing to consider.
Yeah, I think that one of the things that would be helpful as we move forward is maybe, in addition to the total RV and the product types, one of the things we might look at is adding a aggregate motorhome data point and an aggregate towable data point to round all those up. I think we have a few more questions. We're running low on time, so let's quickly roll through these. What about the supply chain and labor shortage carrying forward to 2021? What would be? We already answered that one. Sorry.
Yep. Let's see.
Oh yeah.
Predictions as to when, what month suppliers get a hold of their build challenges. I just am not comfortable going forward with a month. That just, there's too much going on for me to have any real empirical basis for saying that. I would expect, as I was saying earlier, I think early 2021, we're going to start to be back in more of a sinus rhythm, would be my expectation.
Right. And you sort of, a question about the market recovery for the upper end Class A market. I think your previous answer addressed that a little bit, Eric, in terms of, we see Class A sort of doing better in 2021, and that sort of coincides with, greater market growth, greater funding availability, higher end buyers entering the market.
Great. So I'm happy, let's see, my email address is epost@itreconomics.com. I'm certainly happy to entertain more questions. I'm sorry if I didn't get to everyone's, but like I said, always here, happy to help, and I will try and answer whatever you have.
I think we got through most of them, and I will say this, I think moving forward, in addition to, with Eric and Lindsay, I think what we'd like to do is, and maybe on a little bit quicker turnaround than we were able to get this one done, is to coincide when we release the quarterly RV Roadsigns, to continue these monthly, to have, go to a little bit more in-depth insight that you just, can't really put into a report that's 8 pages long and has all that data, just to give a little bit more context to everything. And certainly, we won't have to go through that first part that's sort of a primer on ITR and how they approaching methodology. It'll be much more focused on the forecast and what they see. So hopefully we'll be able to do that. That's our plan. I want to thank Eric and Lindsay. We selected them. I think, the presentation they did today bears it out. They're a very broad, great team that takes a lot of things into account. They're a pleasure to work with. They're going to be an asset for the industry. And, we look forward to a lot more forecasts with them. So again, if you need anything, email me, bbaker@rvi.org, and I can put you in touch with Eric. I think we covered most things. Again, we want to thank you so much for joining us today. I hope we covered some of the things that we were, getting questions about as we made this transition to ITR. And again, the seminar is recorded. It will be in the members only section. The slide deck will be available. So again, thank you for participating, and we'll look forward to talking to you again soon here in about probably a couple months.
Thank you, Bill, so much, and to all the members as well. I really appreciate everyone providing all the color about the industry. It was really helpful.
All right, thanks. Have a good afternoon, everyone.